Who's on? Santiago? Alan? You guys hear me? I don't have the mic on yet. Can you guys hear the music? I never know if it comes through or not. No music? Really? I can't hear the background? Really? It's weird. It's loud, man. It must be because it's coming from must be because it's coming from the computer and it only picks up outside, maybe. What's up, Chris? All right, hold on a second then. I'm just blasting myself out. Hold on. Well, I'm gonna have to get some speakers for the office then. This is getting late. After hours like this, we're gonna need some more energy on a day like today. Let me see if I can remedy this. I can be a little bit more unruly when it's later in the day here. Nobody's really around. Not that I care anyway. Hear that? I can hold it here. Or what sounds better? Up there? This. All right. was a good song. You know what that song reminds me of? When I first got into the business. True story. Got in the business at, this was like 2006. It was right out of school, and I was having my first daughter, and I started an internet e-commerce business right out of school. It was going pretty good. We did a lot with affiliate marketing, and then it just wasn't cash flowing though. And then I was going to have Kayla, and it's like I needed health insurance and all this stuff, and I was 23, so I was for a while there. I was parking cars at Hertz, at the DIA International, and then I was selling timeshare in the evenings for health insurance. Well, and then I was building my internet business, and the guy used to play Thunderstruck before the sales meetings, the timeshare sales meetings, and it was so hard to get up for like selling timeshare. It was not me. Like there's the people that sold the timeshare were like the really bubbly couple women. They're really bubbly. They went on all the vacations. They could just get everybody all emotional. And I don't sell like that. I'm too logical, analytical. And so I would just sit there and just tell the people, I was like, based on what you guys earn and this and that, I was like, it's not for you. And I had one lady come in one day, and she worked at Schwab, and she's talking to me because you spend like an hour or 2 hours, in those sales meetings, if you guys have ever done those. And so we were talking the whole time. She's like, you're a cool guy. We have to hire a bunch of new sales guys. And I had my bachelor's in finance. And I was like, I want to get back into finance. I got to do something else besides this internet entrepreneur thing. And I don't know if I'm going to be able to sell the company, but I want to get, I was trading options forever through high school and college. And I was like, the office was just down the street. So she's like, I'll get you a job, or I'll get you an interview with my boss and whatever. So that's how she actually got me in the door. That's how I started in the business. Schwab, got licensed and everything there. I mean, I was trading for a while before, but nothing on the professional side. But our boss, the head sales guy, he was a cool guy. He blasted Thunderstruck before every meeting. That's what that song reminds me of. Well, anyway, how are you guys doing? Some of you are on the team. There's a few people here that are new. Did you guys have a good day today? I know like Santiago was on the farm, but man, it felt good to feel the market go no bid for the first time in a while. Yeah, Santi, I heard you talking about drumming and stuff. Is that one of your things? Kyle, you can't hear? Not sure why, buddy. Yeah, I'm sorry, Kyle. It's just me on audio. I think everybody else would be mute. So I'm just looking at his text. And if you guys want to text, there's a setting sometimes that says text to all panelists and attendees. That way everybody can see who you're texting, or everybody on the chat can see. So some of you guys did good then yesterday, because not only were we short calls, and then Some of you rolled into puts. Yeah, if I turn everybody's mic on, I mean, some of you would be at the bar, some of you would be, I don't know, with the young ones at the dinner table. But what I want to cover tonight, I just want to roll through. I don't have anything really formal set up. Sometimes we'll do some of these webinars and I'll get into specifics on what we want to kind of teach. We've had a pretty heavy week on the coaching side, so I don't really have a whole slide deck prepared. But what I want to talk about is where the markets are now, how we came into this week, how we were set up, what I think going forward. And not what I think going forward, just what the cycles, where we are in time and what the trends, what price action is telling us. I know some of you weren't in the room today. So if you guys have questions, I mean, you can throw them in there. I'll try to glance at them as I go here, or it might be a little bit easier at the end. I'll be a little bit more focused. Does everybody see my chart? Okay. All right, so I don't want to get into my background that much, but for those of you that might be new, I traded on the institutional sides. We ran a couple rates desks. I traded fixed income. I was a treasury guy. We traded 2s through 30s mostly, pretty much all cash. Sometimes we would do some stuff in futures, but I covered all the primary dealers, so all the heads of the desk, all the primary dealers, at least on the U.S. side. So I talked to the heads of the desk of 2-year, 5-year trader at Deutsche Bank. I cover a lot of money side, big money managers, hedge fund guys from Balyasny, More Capital. But we really were specific on the directional fixed income markets, and we did a lot of cycle work on those markets. But then we would do some work. Sometimes guys, especially on the hedge fund side, you'd have a lot more traders that were trading 10s around with me, 10s or 30s, but then they'd also be short oil or wanted to know what we thought about the euro. So the nice thing about our model is you can apply it to any market, any time frame. And let me just throw this up since I'm on the topic. So kind of the origins of our model. It's kind of what we discovered is that everything is energy. So the same energy that moves through markets, there's psychology in financial markets, obviously. There's sentiment, there's positioning. But at the end of the day, it's just energy moving through the market. So, and energy really only moves in one form, which is cyclical. So whether it's the light from the sun to the atoms vibrating on the desk here, everything is wave formation vibration. And so when you kind of grasp some of those physics and some of those truths in the other sciences, people don't like to think about economics and markets in a scientific fashion, but yet it's the same. We're all part of the same dimension that those laws of physics apply to. So there's definitely waves and vibration and energy that goes through the financial markets. I don't have everything teed up today. I have some slides some work I've been doing on like studying the random coin flips and how you can flip a coin 1,000 times and you'll see a cycle show up. You can study turbulence, air turbulence, and how completely random. That's why, like, you get on a plane and pilots can't figure out. It's, yeah, we may experience turbulence, but you can never see it's coming. It's one of those weird phenomenons in nature that we still don't really understand. So volatility moves a lot like air turbulence. It just kind of comes out of nowhere. It clusters. But there's cycles and waves and patterns and all that stuff. I actually just threw together a cycle chart here in the River room that I had this idea right before I jumped on, and let's see if I can bring it up real quick. So this is one of the, I was studying some old cyclical work that some of these guys have done back, Foundation for the Study of Cycles. But here's a salmon cycle. Any of you guys been to Alaska or from Alaska? It's one of the most beautiful places I've ever been. Catch a can. We were pulling salmon right out of the river barehanded, not even kidding. And they were running upstream. So these cycles exist everywhere in nature, and we're pretty familiar with that. But for whatever reason, we haven't evolved into that. There's a lot of the big successful traders have understood they're all cycle guys, but really, it's not really taught. I mean, technical analysis wasn't really taught. Nobody knew it was in the 80s. The guys that taught me the bond business were in the pits in Chicago, and they did technical analysis right out of Notre Dame in literally 83, 85, and they used to have to convince people what technical analysis was and the charts they were doing. Nobody used that stuff. And then today, everybody's a proclaimed technical analyst. So just like the charts and technical analysis has become pretty forefront, I think cyclical analysis is the next thing, and hopefully we're kind of leading the charge on that a little bit. But I still don't think many people know how to apply it to their trading. This is, you can take this Caterpillar, this is a link cycle. This data is from 1850 to 1960. But anyway, I'm doing some work on some of this because that's kind of what I like to do. It's interesting to me. So anyway, we're cycle guys. Obviously, price and trend, the trend matters. Position size matters. How you add and reduce to your risk. How you work your position. All that stuff matters. You got to put it all together. But the point I wanted to make is that really the origins of our model are based on not just price, but the cyclicality of everything. And then that's another old wall myth, or maybe the fact that they haven't evolved past storytelling and just making up, chasing around news headlines or whatever people jump from headline to headline constantly. And instead of trying to figure out why the market did what it did, if you start to understand that there's a rhythm to everything, just like there's a rhythm to your heartbeat, well, the market has those same cycles. Sometimes they're fast, sometimes they get longer. And so, well, that's kind of what we do. And we had some amazing Bitcoin cycles that some of you have kind of followed us on through the peak in December when we were sellers in the 19,000. And then you had like 13 or 14 consecutive 8-week cycles that played out to a T. I don't have that stuff up to show. But point being is I'm not really here to convince you guys of that. That's just what we do. So why we liked being long the VIX here as of Monday, and I talked about this was probably the best place to be long, and one of the biggest opportunities in the market was just because of where we are in terms of the cycle. So when you look at a daily cycle of this is the VIX futures, we brought the low down here at 15, below 16 was the low. And not only is the weekly cycle low, daily cycle was low, we have a concept that I wanted to just teach you guys tonight that I came up with. Anybody that has this 314 period moving average on their chart is something that I came up with. It's not earth shattering as far as it's pretty a simple discovery, but it's a pretty profound cyclical concept, and it works all the time. So all my years in trading and talking to traders and sending them charts, and it didn't matter their asset class, nobody really uses outside of a 200 period moving average. I mean, I've never seen any institutional person send me a chart in Bloomberg that was outside of 200 period moving average. But in my background studying cycles, one of the concepts we have is this is called our pi line. So the perfect cycle is pi 3.14. We all kind of know the significance of that in mathematics, geometry, etc. So I started playing around with a moving average a little bit longer than that. And we don't prescribe to like the moving average is the best trading model. And when this one crosses and that one crosses and, oh, I'm above it, I'm below it. That's not how we trade. There's way more to trading than just moving averages. But from a cyclical standpoint, why this average works well is what I've found is not because it's a line on the chart, because it's actually taking into account time, certain units of time. And so when you're thinking cyclically, to take an average of a price will give you a number. But when you actually take price on a standard deviation and then you reference that over units of time, you're actually referencing a point that then is actually cyclical. And so what we found is price moves away from that line, then it moves back to that line. It moves away from that line, it moves back to that line. And so you can start to manage risk on a fractal manner, meaning not just the weekly chart, the daily chart, the monthly chart. We don't just buy when it gets down to there on the daily. There's plenty of examples in this across different markets on a 1 minute time frame, 5 minute time frame. But this is just one tool and one concept I wanted to teach you guys for jumping on here is that this is a powerful thing you can put on your chart and in your trading. I just pulled this up and use this tomorrow on pretty much any asset class in any time frame. So what's happening, and this is the futures chart, but I'll show some other examples. So price will like to cycle away from it, back to it, 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 away from it, back to it. And so you can kind of, depending on where you are in the trend, you can plan your trades around that. And then more importantly, where you are in time, you can anticipate turns and another thing that's great about this moving average is a lot of people that have poor trading models that want to be long or bullish when you're above a certain moving average and when you're below it. We don't do that. We care about where you are in the trend. So like, for example, the VIX has been in a downtrend up until basically last night. This is the near term 5 minute chart. And so it's foolish just because you get above the 200 to want to be going long. Each time if you would have done that, you would have been short, stopped out, and then flipping and going long only to be to be whipsawed and come right back the other way. But there's still a lot of there's really a lot of quants, but a lot of people that have, I don't know, maybe poor trading model that do that. And so this pie concept actually will catch a lot of those traps because people go long right when you should actually be going short in that scenario. You guys think of some others that we've done that recently on? And so while the majority of the crowd might be getting, well, here's an example on Apple. When majority are getting bearish, I mean, you can see it on CNBC all the time. You come in here and they're like, oh, well, first of all, the market's down 20%. Now we're in a bear market. And you can never define a trend by percentages. It has to do with your highs and lows. Only when you start to break to lower lows and lower highs are you in a downtrend. It has to do with the highs and lows. There's nothing to do with percentages. But this is a good example. A lot of people went short underneath the 200 here, whereas we were getting bullish. You're in front of pie. You cycled here, same thing. You held pie, cycled away to it, cycled back to it. Those are both traps that I remember in 2018. Here's some examples on the weekly level. Here we held the 200 week pretty much the whole way through. Let me show one other thing here. Second. Go to the max that I can on the daily chart here. Those were the two best examples right off the top of my head. You held pie, but you broke the 200, trapped everybody in. This was a deeper pullback. Again, you can see they held pie exactly, bounced to the underside of the 200. We could probably find some other examples as we go. But let's just talk about what's been going on recently. So we've had the call that growth has been slowing. We've had that kind of call since August and September. So from a global macro perspective, we wanted to express that via being long treasuries, long the dollar. We pivoted long bullish the dollar in April. And then weren't quite aggressive about selling stocks until we really started to break here in October. But the other markets started to turn first. The dollar turned. I don't know how many of you are global macro traders, but it just means you're looking at the entire global economy, and that's on a cyclical 8.6-year wave. And the last peak was 2015. We were on a down cycle into 2020, and but growth in the U.S. first, growth in China started to slow at the beginning of 2018. Europe was slowing for a while, all of last year. Just now, finally starting to make some of the headlines, being in a recession. And then the U.S. is the only economy that's holding up the world right now. And it started to slow in September, October, November, December. I think this cycle probably plays out into 2020. And I don't know how many of you have traded a bear market, but I've traded 2007, 2008. Bond market was absolutely nuts. It was like the front row seat to the end of the world trading treasuries during that time. You had 10s going 3, 4, 5 points. A long bond was going 8 points in a day. 2s were going 4 points in a day. They maybe moved like 4 ticks. Now it was going 4 points. So this is the first real kind of big picture growth slowing risk we've had and recession risk we've had. And we're not trying to make the call that we're moving into recession. What we care about is that the cycle is slowing. So I teach my guys, we care about the cycles as far as a chart we're trading, whether it be whatever we're trading, we care about the cycles. But then big picture cycles, we care about where is GDP. And we just came off of 9 consecutive quarters of growth since Trump got elected. And the numbers just went from great to good. And my guys know that. Going from great to good, you're still slowing. And now the real risk is the numbers go from good to okay to if not bad. So Europe and China is already well on its way down this sine curve. And the US is we're already at this point. So just when everybody couldn't be more bullish 4 months ago, right on the highs, they don't see the rate of change. Just because the number is good doesn't mean it's not slowing. So that's a tough part about catching these moves. Is you got to realize that it still could be a good number. You're going to still have jobs. The jobs data is going to be great because that's always late cycle. But when you roll off the top, just like in 07, you got to realize going from great to good is still slowing. And so I think we're kind of right at this point. And we're going to see here. These next 2 quarters are earnings. We're coming off a huge cyclical peak in pretty much everything, from jobs data to corporate profits to you got to talk about inflation in here also. Confidence is starting to come off. If you look at the ISM manufacturing, that's cratering. ISM services is doing this now. So that's just one component of it. Obviously, you can have rallies inside of what we think is a bearish trend now. And so, again, that's why the timing is so important. And that's why I think there's a lot of value to what we do in our model, is just making a big picture call. Bitcoin's going to 500,000. Maybe it will be there 5 years from now, but not really helpful when it goes from 19,000 to 3,000 and then sideways for 2 years before it finally hits 500,000. So you got to get the timing piece right. And that's where the fundamentals and the valuation is just not helpful. You can use that in your thinking about where a market might go, or like we're obviously paying attention to it, big picture where we are. But you could have all the data right on growth slowing and GDP. You could nail everything perfectly, and that doesn't help you from being short down here and sitting through the biggest rally to start a year in 32 years we just had. So you gotta learn to manage the risk around the fundamental view. I got a lot on that chart. All right, so here's what I think is the most important thing in the market right now, is that we'll just talk U.S. equities. We've been bearish Europe. We've been bearish China for a while. It's not really that easy to trade those markets from like a future standpoint. You can trade the ETFs, but we mostly trade. If we're bearish equities, we mostly express that view in the U.S. And I know you guys are on the team. This is kind of redundant for you, but these cycles I have listed here are actually on the daily. It'll make more sense in a second. But the main cycle that's dominating this last move here is this weekly cycle. So we bottomed the day before Christmas. The cycle crossed that same time frame, the 24th, and this is an oscillator. So I'm not going to get into why we use this as a cycle. Some people use it overbought, oversold. It's a rhythm here that I care about. So this oscillation of time, we're actually moving into 7-8 weeks off the low. And I mentioned pi earlier. 8.6 is actually a derivative of pi. I'll show you something to help with that. Santiago, you're looking at Amazon cycle? What chart should I look at on that? The daily? Oh, okay. Okay, buddy, thanks. So pi, so the business cycle is 8.6 years. It's been discovered by several people. Kind of always fall around 7 to 9 to 10 years, but I studied Martin Armstrong stuff. I really won't spend the time to get into who he is, but he's done the most in-depth research on financial panics and the cycle that plays out on that. But it's an 8.6 year global business. It's a wave. But when you get into pi, 8.6 years happens to be 3,141 days. So it's pi times 1,000. And that shows up in Fibonacci. It shows up in a lot of anybody that's done any cyclical work. That's pretty common derivative of pi is 8.6, and then you get to 13 and so on. And so we do those 8.6 counts, and I'll show you on the daily in a second. But we're 1, 2, 3, 4, 5, 6, 7. This is the 8th week. We've been off the high, 7th or 8th week. So that's lining up with probably going to get a lower high relative to the high we made in December. And then you have your weekly oscillator. We go to the daily level. You can see how well, again, this is a rhythm. You guys are new to cycles. I mean, I show this stuff all the time, but this is your double top high, 8 days apart. You dropped into a low. You had another cycle count. Again, it's 8.6, so some days it might be a 9 count. Made the low, cycled up 8 days, made the high, cycled down 9 days, 8 days up, 2 cycles down, exactly the low. And then we've had 3 cycles up. All right, because you've got smaller cycles inside of larger cycles. And that's just the fractal nature of how things are. So this is a longer weekly wave that's kind of playing out here. And that appears to be kind of what we're on. So there's some signs today that we liked that showed that this is the best trigger sell signal we've had since the 22nd. And even on that day, we couldn't take out the prior day's low. So I'm trying not to get too bared up, but I like this narrow range bar here right into the 200 with all the technicians have. Our pi line is right in the same area. So from a cyclical standpoint, that makes sense. And then this is what we call a swing line setup in our model. It's something that we teach. It's one of the 8 setups we teach. But this is a pretty bearish close. Now what I want to see tomorrow, each one of these bearish days, here we had a swing line set up, and this was just after too much pain, this was too much bearishness at once. And then we had a 30 halt with a higher low, and that kind of set off this whole rally. That was a bit of a bear trap here. All right, but that was the same. We haven't had a 2-day down day since then, which is crazy. So I'm not considering this day a down day. It's just like kind of like a narrow range bar, do nothing type of day. But these narrow range bars are kind of powerful when they show up at the end of the move. Pretty narrow bar, then boom. Pretty narrow bar here, boom. So we like this day today. We made good money today. because we were kind of setting up short into this move on the smaller time frames. But then I really would like to see, without jinxing it, some follow through tomorrow, which we've trying to struggle to put together 2 down days. So Santiago is going to look at your Amazon. Oh yeah, right here, buddy. That was classic. You cannot be short. You can't have a fall from here to here, and then just because you trade underneath this line, decide you want to go short after all of this. It's like the worst thing. That's the last thing you want to do. But yet, I'm telling you, there's so many money managers that are chasing this short right here. We're below the 200. They're chasing all of this, and then what do? Hold, bounce, squeeze all those guys back right to the band. And he essentially had another hold of pie here. That was what you were talking about, right, Santiago? Yeah, I mean, so it depends how you play it. I mean, this is still here on the daily, but we're starting to traverse pie, so it's becoming less. It's becoming more of a range trade as you traverse that line, because cyclically you're starting to move. Those lines will start to move in the middle of your range. So we've already moved away from it, back to it, away from it, back to it. So as you trade both sides of it, kind of becomes more the mean than but you know what you're doing. I mean, look, just random picking different time frames. Some of you trading currencies. Look at all these holds here. Fail at the underside. So you can express the world kind of going in the shitter in a lot of different ways. But it's usually long dollar, long treasuries, long gold. Gold, you got to be you got to trade it with dollar and inflation a little bit more. Lately, there's a great failure here, pie on Aussie yen. That's on the daily level. Here, there was another failure at the 4-hour pie. So anyway, Aussie yen is another risk off type of global macro play. So the Aussie is considered a riskier currency. So when China is exploding with growth and people are buying up commodities, Australia is kind of thought of as more of a commodity type of producing country. So, and just for a lot of other reasons, but if you're going to be bearish on the world economy, you tend to want to be a seller of the Aussie versus the dollar. You want to be a buyer of the US dollar. People sell assets that moves them into the dollar because it's the world's reserve currency. It tends to create a bid for the dollar, among other reasons. But that's one that as you can see, we've been grinding higher all year, all January, because of this rally in stocks, and then we failed essentially right into pie here, and we had a big move down yesterday. Aussie actually was the first kind of market to roll over. You could argue oil kind of started to roll over also here last week. That's another part of the risk off move, right? If global demand is falling, you want to be short oil. So that was kind of one of the calls we had. We were shorting at 74. I did try a couple times. What else, guys? I mean, I'm just trying to, I know I promised I would talk about the pie line. So, I mean, I'm just glancing at stuff. And then the other thing I wanted to talk about was this idea of how the markets are fractal. Meaning, if you look at it in nature, you'll have, well, maybe I have a better visual on one of the slide decks. So I'm bringing up slides from a little bit of what we teach in our model, our trading model. So here's me again explaining. This is a 9-hour course. I explain all the stuff, origins and markets. We get into execution, risk, psychology of trading, trading plan. But these sine curves that, there's a geometry to time, not just space. So space has to do with, obviously, we study that in geometry, but you're going to find that in time too when you look at pi is a function of the cosine. And just one more point on pi. This one I always love. If you guys look at if you know what the precession of the equinox is, so when you look at the cosmos, they're really long cycles, obviously, much more wider area of space, and time continues out much further when you zoom out. And so 8.6 years, I said that before, pi times 1,000 days, but you take 8.6 times 3, so a derivative of 8.6 is 25.8. That's exactly the amount of time the Earth takes to rotate. The axis of the Earth takes to rotate. So it's all there in nature around us, and then it's just a matter of realizing that those cycles exist in nature also. You guys are staring at the top of my head. Sorry about that. But the fractal parts of what I mean by, we're going to look at in a second, how we were shorting the NASDAQ on one level and then adding to it on another level. And then today we were actually adding and shorting on a third level. And so there's these smaller trends that build into the larger trends, right? So just like a fern leaf, you can take this one part of the leaf, it's the same as this part, which is the same as this part, which is the same as this part. There's lots of examples of that in nature. Back to the chart. So this is the Dow. We've been playing this on the long side, and then this is the NASDAQ, which we've been bearish tech since this. We were selling out of Apple longs right at, I don't know, 210, 220, right on the highs, and then we didn't get bearish till basically September, October. But especially in the November, December, high beta tech was the worst performer, just like it's been the best performer on the bounce because it was the most knocked down. But it's still the high beta, the tech, all that stuff, when growth is slowing or you're slowing at a rapid pace, or you're moving towards recession, that's the stuff that's going to get beat up the most. So you look at how hard tech was down, that's why. So we've gone back to that now. Again, after the weekly cycle's up, we've been waiting on some of the intermediate term to break. The daily cycle's there. So we had a pretty good call. I hadn't shorted the NASDAQ since like November. I don't even think I shorted it then. I was just short S&Ps. So I hadn't pulled the trigger on the NASDAQ till both of these tops and these highs. And that wasn't about feel or anything other than the cycles and time. And so these are obviously good levels up here underneath the 200-day, but you gotta, there's more to it than just, again, the moving average. So we start shorting the higher time frame based on the cycles, and then when we looked at the daily, we go to this intermediate term time frame beneath that, the fractal layer beneath that, and then we picked our spots on like the hourly and the 30-minute. And this is where starting to learn to work position size, and we're working with some of the guys in the coaching and mentorship program. You know, so here's the Dow. So I was playing the Dow long for a lot of this move up this year on the long side. So we're even though we can have a bearish long-term view, we're still going to come in here and buy the dips on the near term and the intermediate term if that's bullish. But then at the end of the cycle, what happens is you're eventually buying the dip. You're going to buy the last couple dips that break. And so this is where when you learn to start to play what we call pairs trades, you can play two assets against each other and still have a really good day, even though you were long the Dow, because you've been rolling into the other side of that, which was short tech. And you play the two off each other. Can't explain all of it right now. But so when we're coming out of some of our long, we're starting to feed into the short. So I'm coming out of my long, I'm long out of my longs. Yesterday, we pretty much sold the high of the move. All right, short in here. So I was long and short, which some people don't get that. Were you long and you're short? How could that be? You're either bullish or you're bearish. No, it depends on the time. And I can be bullish for the next 10 minutes. I can be bullish for the next 10 years. I can be bearish for the next 3 weeks. And so it's the people that don't do global macro and they don't have a process, they can't, if they don't have a multi-duration process, they don't understand this concept of being long and short at the same time and on different time frames. So we're long here. And then what happened today, which is what I wanted to talk about, is short covered some, come in this morning, the market's down. So my short here is already in the money, and the VIX that we were buying is up nicely. So I'm already up on the day, despite my Dow long, which has been the one that's been performing the best for all of January. Now it's suddenly coming in against me, right? So I'm down here. But as we were covering, taking profit on some, we had this bounce. And so I used this bounce. So I covered here, basically, I don't have it zoomed in, but we were covering short NASDAQ here. And then as we bounced back up, we used that bounce to sell out of the Dow that we were long. And then some of you added short here. And then some of you just said, no, we'll wait. I'll wait for higher to sell. If we get that, fine. If not, it's no big deal. And then the market craters. So on this little bounce, we basically took profit, added to some shorts, used that bounce to come out of the long, which isn't that far away from some of the buys we had yesterday. And then you get the bounce of the underside of the 200, which is why we wanted to sell. And then you got the crater. So on this move, we got a lot of alpha because we got, not only did we get out of the Dow on the bounce, then some of you added to the short, and then we were covering into the low. And then again down here, we're buying the Dow. If you sold the Dow here, and then you make a bunch of money on the VIX and short the NASDAQ, then it's easy to come in here, you're up 4,000 on the day, and say, all right, I'm going to lock in those gains, buy the Dow when it's down here after I sold here. And then we got a bounce, took profit on the bounce on the Dow. And then again, we added back to the NASDAQ short here, most recently into the day. So you play, it's kind of a, global macro is you can play two equity markets like this over two time frames against each other. But then you can do the same thing for maybe being long the VIX versus being long S&Ps, or you could play euro short, dollar long against gold longs, and you can play those two pairs off each other, because if the dollar really goes up a lot, then gold comes down, you buy gold. Dollar sells off hard, gold usually catches a bid, goes up, then you're making money on your gold. Like all those pairs trades. So we do a lot of that. You can do it in treasuries. You could do it 5s versus 10s. I'm teaching a lot of you that in treasuries. That's kind of my background. You play the yield curve. So even though we've been long bullish bonds, we've been staying core long 30s, right, guys, since what, September? Even a little bit before that. But you stay core long, say 10s and 30s, but just like when the market gets high, I can sell some 5s when the market gets overbought. So if I'm buying the 30-year well down here and the market rallies, I take my gains on my 10s and my 30s. Not all of it, but I take some profits. And then maybe you decide you want to sell some 5 years against that. And then when it gets low, you cover those 5s back down here, recovering. This was a good hold of pie. I just didn't want to take it all off, so I don't have any buys there. But and then today we talked about even reshorting. I didn't short in this account, but I did sell a couple 5s in another account I have. Because if we were buying 114.12, 10 ticks higher, it's a good place to reshort some 5s. So this is how you manage real risk. This is how the big money to pros do it. You're not just in, out, long, short, stabbing at one price, I'm out at one price. No, you're scaling in, you're scaling out. You're holding a position, but as the market rallies, you come out, take some profit. As it pulls back, you're buying some back. And it's this constant adding, I call it adding and reducing around a core position. So we do that on individual plays. You could do that on Chronos, like if some of you guys are into the pot stocks. We're adding and reducing. Somebody on Twitter or something told me that we were never going to get a pullback at 25. That's why he was not going to sell, because he felt like we were never going to pull back. Well, I was like, well, you got to take some, man. We were back at 19 today. So there's lots of opportunities to buy, add, take some off, ride the core long, take some, buy some back. When we nailed the low today, or was it today? Was that low today, guys? 19 or something? Take some off, buy some back. So you can stay long one particular asset and trade around it. And then you can trade individual markets against each other. You could trade 5s against long 30s, like I just explained. And then you could take even a bigger view and trade short S&P, short the NASDAQ, short the Russell, but then long the Dow, different time frames. And when everything rolls over, then you're short everything together. Those are the times where you're going to make the most money. But this is how you run a long short book. This is how you get past the amateur, like in, out. I already explained that. Hey, Tyler. Yes, you can add and reduce on the option side too. The options is just how you're going to express how you're going to execute, right? Well, that's a good question, because options actually allows you to be even a little bit more fancy. So I think you should always be adding and reducing. You should always be trading. I teach you should be getting in 1 to 10 lots and scaling in. Most people enter in one time with like 2 targets in mind, and they target trade. I mean, that's probably the most inaccurate way you could trade. You give yourself one entry, you give yourself one point in time at one level to be right. But what if it comes against you a little bit? You don't get the chance to add at lower prices. If you set your target here and the market rallies and then fails right in front of your target and then craters, you never get out. It just doesn't. That shit doesn't work. So you should add and reduce no matter what. But how you express your view, if you're buying shares, if you're buying futures, if you're trading the Forex market, swaps, options. But yeah, the cool thing about the options market is what I teach in the options course is actually options will, it sounds corny, but options will give you more options. And I talk about that in terms of optionality. So like today we were talking about if the market rallied, it was a win-win situation either way. If the market rallied in the Dow, then we were going to come out of our Dow long and we were going to sell more than NASDAQ because we had just covered the low. If the market kept going down, we were just going to make more money. So either way, it was a win-win situation to us because we knew how we were going to play it. And we have the right balance in the portfolio, we have the right balance of risk. But in options, you can do that because you can actually have both sides of the market at the same time. So I'll try to explain it. So this is the VIX. This is the VIX futures. So we've been getting long VIX calls down here. And I was long VIX futures actually on another different account, but it's the same thinking. So all right, let me try to explain it this way, Tyler. So if I want to be bullish, so this is the daily chart, this is the 1 hour. So we were coming out of a lot of our long here at 27. I mean, we pretty much sold the high here on the VIX a couple times, right? And we were buying the dips in here. But we were bullish for this cycle. And then there were some opportunities to try long in here, but this was really light. Like after this move here, I mean, I haven't traded long VIX futures. I did one here, sold into here, and then I haven't touched it, VIX futures till Monday and today, because the 30-minute cycle was down, and we were just waiting on this daily cycle mostly, and then we were waiting on the weekly cycle. But now I was saying I think this is one of the best opportunities in the market because I think you're going to have another cycle here. Just like we had one here, you're going to have another. So you have the risk reward is really good in this market, considering growth is slowing. It was going to be really hard to get the market to a VIX of like 12, 13. So you knew kind of where you could start scaling in and getting more aggressive. Pretty well-defined trade. And so when you get long or you get bullish like that, let's say that I put this trade on, I first come into the market long, let's just say last week. Well, I started nibbling on the VIX here. I think that was last week. No. It's Friday, right, Santiago? You and I were talking. Thursday or Friday of last week, I started to beef this up. So when you have the options on, the cool about a part of like options is you can design different spreads. So when I was putting this on, I was going out and buying 17 strike calls, and I'm still long, 19 strike calls, 20 strike calls. And then I was doing what's called a ratio back spread. I teach this in my options course. So I'm bullish, and I'm expressing that view by buying upside calls, right? So if the market goes up, I make money. But at the same time, I'm putting on short calls, 16, 15, 14 on the downside. So I might be short 10 strike here, 10 contracts here, 10 contracts here. But then on the upside, I'm going long 30, 50, 50. And so I have both sides of the market. So the nice part, this is kind of to answer your question, is like a long-winded answer, is that if the market pulls back against me, these short calls are actually moving in my favor, because that's being short calls as the market goes down, is price is going to go up in your favor. So I'm making money on this side, and that's actually, we could see this blue candle is me taking off the short side. It's bullish because I'm taking off the short side, so I'm getting net longer. But I'm realizing some of these calls first, and then naturally it's called delta. My delta is getting higher because I'm taking off some of the short calls. So it's, in a form, it's a way of me adding. As the price comes lower, I'm adding. And then here I actually bought more calls. So my delta was 5,000. So I was basically like long 5,000 shares here. But when I started the trade, it was maybe like 2,000. And then here I was covering my short calls. So then I just had the upside. So you can add and reduce a little bit like that. We call that legging around. So you could have done that here. You could have sold off. We did that a little bit today. Booked gains on the 18 strike calls when we popped. And then when we were up here, I sold 16 strike calls. And then as the market comes back down, those short 16 strike calls are going in my favor. So then I book those, which naturally gets me more long again. So that's the same. So the answer is yes. It's the same add and reduce. Directionally, it's the same. But with options, you can kind of have both sides of the market at the same time. Versus like treasuries, if you weren't using options, how are you going to have both sides of the market? Oh, you could be long 10s and short 5s, and you have kind of both sides of the market. But with options, you can kind of be long and short the same underlying security without having to go to another instrument, without having to trade like UVXY, which is another ETF, against the VIX. That was a long answer. But this is still one of my favorite trades, and we've been frustrated with January because, again, we've had these big 1 day down days, and it goes right back to 4 days the other way. But if this weekly cycle plays out, there's a pretty high probability that we're coming to like 20 on the VIX here. And if not, I'll manage my risk below here. So we'll keep adding and reducing. When we had this move up here, I was buying the Dow when the VIX was up here, just a way to, again, kind of hedge the pullback. Yeah, man. So anyway, guys, look, there's another example. VIX hourly held high. Nobody else has this on their chart. Nobody has a 314 period moving average. So it's not like everybody's staring at 200 like they're doing on the Dow and the US indices right now. Everybody is watching the 200 on the indexes. This is not a self-fulfilling prophecy. The reason this works so well is, I'm telling you, because it's cyclical. It's about time. It's not about a line on the chart. Alexander, I don't know what the hand raising does. Did you shoot me a message that I didn't miss or something? What do you want to say? Oh, Kyle. Where you're wrong, ideal stop placement. Is that the question? Yeah, so that's one of the biggest things, obviously, in trading is where's your stop or where's your risk. And I think when you're first starting out, it's probably good to put in what's called a hard stop, which means you actually put the order in with the broker, right? Or you put it on your screen. So let's say this is the euro versus the dollar. Let's say you wanted to be long down here, right? And maybe you use this as your low. You can go put in what's called a hard stop, right? And maybe this isn't your question, but you need to know where. Trying to define where to put stops is about where are you wrong, but to me, what defines where you're wrong has to do with where does the trend change, and then where are you at in the cycle. So if I'm bullish on something, when would I decide to get out of it? When it stops being bullish? Well, what makes it bullish? It's an uptrend. Well, what makes it an uptrend? It's making higher lows and higher highs. So by definition, when do I want to get out of that? When the trend changes. Okay, well, where does the trend change? You have to know correctly how to identify the trend. And there's a lot of poor ways to do that. People using averages. People say 20% correction, you're in a bear market. We do something that's called TMS. What I call TMS, it's called technical market structure. And that's meaning I teach people how to truly identify the trend and then how you manage your stops and your risk around that. So trend is one thing, and then you're going to have time, which is another thing, which is almost more important. And so where you are in the cycle, when you're high in the cycle, at a higher high, you want to be taking profit. If you're buying low on the cycle and you break trend, then that's a reason to stop. So you place your stops in areas where the trend changes or whatever you're doing while you're buying. So we have different techniques we teach. You could do a max loss per trade that you could use as a stop. I teach different setups. So here's a topping tail. You take out the low. That's a setup in our model. So if you short there, the stop goes right above the high of the setup. But for the most part, you want to be trading with the trend, and then you stop out when the trend changes. So there's this green arrow here because the trend changed right there. The trend started to change here also on this time frame, but it actually didn't change on the weekly. That's stuff I teach though, how to identify the trend. These are all lower lows. We haven't changed the trend here since the trend has been bearish on the euro since this break. That's just on this. This is a long-term time frame. But yeah, a lot of times we'll take profits because the cycle's low. But a lot of times when you're getting into a trade, the cycle is key because that's when you want to start your trade. Sometimes you'll be early on the cycle. You can start shorting. And it doesn't mean you need to stop out unless you identify where the trend changes. Let me give you an example. So here, just on the VIX, let's say you wanted to be bearish or short. The trend is down here. All right, you've already had this move down. This is an hourly chart, but the 4-hour cycle is going to be low at this point. I can just tell you by looking at this. So you don't want to be starting a short here. High on the cycle here on the hourly is better up here. So if you started shorting here, a good place to know where you're wrong would be above this high. So I'd be willing to short up into this high with the cycle as long as we didn't trade above this high. Because if we got above there, then something's changed. It's going to be looking more bullish. And then you get the drop. Good question. I mean, there's definitely, we teach all that. It's about cycles and time, the trend, but then it's about setups. Like there's a setup here that my traders know. The stop would go right above the high there. And then when you're adding to a play, there's other setups, and so when you're in a profitable trade, you have another dilemma, which is called the trailing stop, right? So if I originally enter short here, I short more, and it's going in my favor, I teach you how to trail out and move your called the trailing stop down. So you're maximizing, you're letting your winner run, but as soon as that gets taken out on the upside, then you're out of the trade. So we have rules for that. We have rules for adding. All the big traders are adders. So this, again, this idea of like 1 or 2 entries and then target trading. The big traders, they risk 1 or 2 lots and then they add in the direction of their play, and they get maybe 5 times, 10 times the amount of sizes when they start the trade, and they're never really at risk. They're only at risk on a few lots. It goes in their favor. They add, they keep their average cost. That's one of the secrets to big trading. And you add in the direction of your play. There's a time to go contrarian, and there's a time to add in the direction of your play. You start off small contrarian, then when it rolls over, you get heavier, you add. And when you add, then you keep an eye on where your average cost is relative to where the price is. And that's how you take a small amount of risk and turns into, that's where you can get 10x, 30 times. This idea of like 3-to-1 risk reward is a silly amateur concept. You can take 1 or 2 grand of risk and turn it into a $30,000 play by adding to it. And if you keep your average cost with a profit cushion, you're never really at risk as long as you don't let that price come back above your trailing stop or your average cost. I don't know if all that squiggly line made sense there. If you can see it. That's true concept though. That's part of the adding and reducing we teach, is that. That's how I call that the art of the size, is knowing how. It's one thing to get the direction right. You see all these technical analysts, oh yeah, we failed at the trend line, but they struggled to be consistent, profitable traders because they don't do well with their position size. It goes a little against their technical analysis. They only enter in 1 or 2 lots. then they miss their target, there's no ebb and flow there. There's no giving yourself room. You can't put your plays in a straitjacket. You got to give them room. You want to add to them in negative territory to some extent. You want to take some off when the market makes those profits available. And there's a ebb and flow to it. And then you got to learn how to add to really put those bigger plays in your favor. And then when you're wrong, you're only wrong on a few lots. And when you're right, you can really be right on a bigger position. So I wouldn't do anything in crypto. I don't even want to spend any more time there. We're just talking concepts. But it's the same stuff applies, guys, to, again, any market. That's why we got into crypto the last couple of years, because there's no barrier to entry on that. We knew right in there to get. There's some guys that even in the office here that trade soybeans. They don't trade anything else. They just know what he's comfortable with. That's fine. But when you learn a model and a process like ours, then you can have the confidence to trade anything that moves, and you want to go wherever, whatever is moving and has the most energy. But I just wanted to share with you guys how to get involved with us. JenkinsRM.com. You should see a lot more of you in the chat room. And it's free to come in here. We have a couple paid rooms where we have real-time alerts. Show some of those. So here you can see these are some of my alerts on Chronos. We were taking profits the other day into the high. That was the 4th. But for $100 a month, this is all our institutional model. There's nothing else that exists like this. And I'm putting in alerts on equities, commodities, Forex, crypto, bonds. So these are all the trades we're doing on. This is ultra bonds, 30-year, 5 years. So that can come right to your phone, your mobile. But it's free to come into this trading floor. All right. So that's what that is. And then under the trading services, I did have a lot of you ask about Forex. So this has been a long process it shouldn't have been this long, but I put everything I could into making sure that it was the right information to get people started the right way. You could do a whole course on just what is a pip and why does one broker have more leverage than the other broker, and you can find all the answers to that stuff, guys, anywhere else. I was just trying to give you the basics of why this market matters, why it's a good market to trade, and then how to get started, and give you concepts like the ones we talked about tonight to actually help you make money, and not just tell you what it is, but actually help you get started and get you way beyond anybody else that just fires up a Forex account and then just throwing indicators all over the place. You'll know 90% more than anybody else is going to know. And I put that together, 3-hour course. I'm not very good about getting the stuff like the video uploaded in the right places and on the site and everything else. So it took a while, but that's there now. So I'm excited about that. I think that's a no-brainer. I paid 12 grand to learn to trade Forex, and I've got 3 concepts out of it, and it was mostly what I just talked about. It was like telling you what a pip is and what's a standard lot. It has nothing to do with like how to actually make money and what pairs you should trade, and nothing like that. So I think that price it's pretty much a no-brainer if you guys want to learn Forex. And I go into stuff on the model too. But if you want all the ins and outs of what we're talking about here tonight, that's the trading course model. I have another one where I teach the model and then I teach the options. So I teach the call ratio spreads we use. So once you get the idea of the direction of the model down and time and cycles, then it's kind of like Tyler's question. Well, how do you want to express that instead of just buying 100 shares or just buying a futures contract? Now I teach you in the options. Okay, let's be long one 10-year note, but we're going to do a call ratio spread when it pulls back, and that way we have both sides of the market. So if it pulls back even more, we take profit on our puts or our short calls, and then when it rallies, we sell our calls back out, and now you're really milking both sides of the move. That's just another higher level of trading. So that's what the options course is. And then the mentorship, this is the group, this is my tight-knit team that they've gone through the course, but then we trade live together. And the whole point of the coaching is, though, I'm not just here to tell you what I've done and my experience and you to mimic me. That's good. That's good to do. I mean, you're going to get good at golf if you go and if you played with Tiger every afternoon, you're going to pick up a lot. But what really it comes down to in trading and the coaching stuff is what you as an individual are doing wrong and what you need help with. So I teach you how to journal your trades, show me your trades. I can see what you're doing right, what wrong actions, what right actions. We can keep working on the good stuff, but then trying to get rid of your bad habits. And that's all. You're not going to get that inside of your own head. If you already knew all the answers, then you wouldn't be having those problems. So you have to have somebody outside of yourself, outside of your consciousness. Hey, Jim, why are you selling the market down every time we're at new lows? Have you thought about maybe not selling 4 lots when you first get in? Have you thought about putting your stop above here? Why are you doing this? Why are you doing that? And that's how you start to get to the answers of whatever it is that's messing you up. And it's usually a 3 or 4 bad habits that you keep doing over and over and over again that you haven't identified. You're not aware of them. Then you haven't identified them. And then you haven't intentionally gone after to get rid of those habits. So that's the stuff that we work on that gets you to that profitability. And so that's a fun team. We do that as a group setting. And then this is like basically the membership. You do the real-time alerts. That's pretty passive. And then we have the live trading room. It's $200 a month, but we're in here trading together all day, or at least every morning, in a live setting like we have right now. So you're trading along with me. We're looking at markets together in real time, talking about what we should do, where the opportunity is, what we think, how we want to position, what's happening. And you do the live room, you get the real-time alerts. So I mean, I don't know how many trades we had today, guys, but some of you sent me screenshots, but people doing $2,000, $3,000, $4,000 a day on relatively small futures accounts. I mean, that's a no-brainer too. I mean, $200 is like cost of cable these days. I guess, and what else? And then we have some copycat services on the Forex side. So the way that works, I have a US account that copycat is just the technology. You can set up your brokerage account, and actually for $150 a month, you keep all the profits and it just mimic all my trades. And you can set it up so that for every dollar of risk I take, you only take 25 cents for risk. which is kind of what I recommend in the beginning. But then it's all automated, so all the trading that I'm doing. Am I on the right screen still? Yeah. I'm like an 80% win rate this week. This year we're at 80% win rate. So that's a pretty cool passive thing. I mean, you keep all the profits. The technology is pretty amazing. And actually Aussie yen is getting crushed right now, which we've been short. You guys see this? Short. Surprised Dave. Surprised you guys didn't wake me up on that. So right now I'm short. There's $300 covering that. Flip screens. I didn't flip screens. And I'll show you in a second. This is actually pretty good. This is what I get, I guess, for adding value to people, huh? So there's customers right now that are tracking my account, and so they don't even have to be doing anything. And when I'm covering these shorts, they're making money on their accounts, and they keep it all. You just pay me the monthly fee to run the copycat service. So this is back to that global macro view we've had. Stocks are probably getting hit too. That when shit starts to hit the fan, you're going to get the yen to catch a bid, most likely. That's always usually a safe haven trade. And then Australia's been in a slowing like crazy. That's the same story as China. And their central banks just finally figuring that out. So they started moving even more dovish as of, was it Monday night? So I'm covering these shorts that we were putting out today on this bounce up this wall. So my traders know there's a wall concept we use. And so this is me covering. Who's short Aussie yen? Dave is. I don't know if he's on. I know. Eating late night tacos. I'm having way too many tacos. I had tacos today too. There's a good taco place right down the street, or across from the office. Probably gonna buy some euro here. And playing a little bit of a long versus the euro. I'm pretty bullish the dollar. It's just the way my position kind of ended up that I'm working long. And cover some euro yen too. Do you guys have any questions before call it a night? Alexander, a link? Yeah. Do you want me to send it to you in River? You were on that before, right? I know. It doesn't matter. I'll send it to you. It's simple. I like this Aussie yen though. This is just another. If this continues overnight, I mean, it's just bearish, guys. Aussie rolling over like this, the yen catching a bid. All right, I guess I'll sign off with you guys. I'm actually traveling. I don't think we're gonna have a normal live room tomorrow because I'm going to Chicago. And I'm catching the bright line down here early to Fort Lauderdale, so pretty comfortable. I can maybe get on the laptop. It'll be pretty early though. It'll be like 7, I think. Otherwise, I'll just try to catch some of it on the mobile, or just we'll do the usual in the chat room. No other questions? The bottom? I think you're close to a bottom, but maybe that's 2,000, you know? I mean, we went 10x from 1,000, 2,000, and you're 100% retrace on an extraordinary bubble like that. It kind of makes sense. You could retrace 100%. But the thing with BTC is that even if you catch the low, there's no rush to get back in because the timing's not there. There's a way to nibble. You can add to your position, but there's no sense in taking a huge position if it's just going to sit there, right, and just go nowhere. So when the timing's right and you start to turn like the intermediate term up and you start to break the trend up, then it's worth more of your capital. But right now, if you commit your capital, there's no reason to let it just sit there, you know? At least with like a treasury bond, you're holding it. Maybe you're getting 2-3%. But there's opportunity to trade it around. But that's why the hodl stuff is kind of silly. It doesn't work in the bear market or sideways market. You're just wasting your time, your capital. But there'll be a time where we'll be more aggressive there. But yeah, come join the chat for all that. That's kind of where we have those discussions. Yeah, exactly. Dead money. There's a time to add and nibble and trade it around off the lows. I mean, we've already had doubles off of Cardano. I mean, I've kind of like buying some of that stuff more because at least it'll when it rallies for a week or two, you got something to talk about. But if something's just flatline, nah. And it's just a time thing. We might be in a 2 to 3 year reaction after a move like that. Anyway, we talk about that stuff in our crypto room. All right, guys, enjoy the rest of your evening. We'll hopefully see somebody in the chat and some of you in the coaching and mentorship program. If you got questions about the model or the Forex course or getting set up for the live room, love to see a bunch of you in the live room tomorrow or next week. All right, guys, good stuff. We'll talk to you. All right, guys, welcome. Have a good one.